Thanks, Andrew, for joining Blue Notes again. ANZ delivered a profit on Friday, a good, well-received profit, strong contributions. One of the strongest contributions came from your business, the International and Institutional Bank. Asia was a particularly strong part of that business. It's now 27% of the institutional revenue in the bank, 29% of the market revenue, both of those growing quite strongly. Can they continue to grow strongly?
Well, yes, I think they can. I mean, I think when we look at what's happening with the trade flows and the foreign direct investment and the wealth flows, we continue to see growth in those marketplaces. If you think very big picture and you compare, say, what we do in Australia versus what we do in Asia, in Australia we have a very large market share in the institutional business. And so growing faster than GDP when you're a bank as big as we are is actually quite a challenge. And in fact, those banks that grow faster than GDP and they have a large market share generally are taking more risk relatively to what's going on in the economy. And given our market positioning in many of these Asian economies, we're not quite that large, so we absolutely have a chance to grow. And those economies are growing faster, of course, than Australia and New Zealand are growing. So there's an opportunity for growth because of our relative market positioning. The second area where there's growth is, of course, in the trade flows themselves. So critically important for our strategy is that we want to be the best connected, the most respected bank. So as a result, that connection means that we have to be on either ends of those trade and FDI flows and wealth flows, which we are, because we've been able to build the market position that allows me to connect Australia to China, that allows me to connect Indonesia to India. And I can connect those corridors and therefore can make money because the amount of trade in that area is actually growing also at higher rates. So yes, we can continue our growth.
The growth was also strong in markets, and I know that the markets business is related to what you're talking about. Historically with Australian banks, though, that markets income has been very lumpy. Can it be more consistent than historically it has been?
Well, I think you need to be a bit careful here when you talk about markets business, right? Somewhere between 75 and 80% of our markets revenue is really just customer flow and serving customers. And so what that means is that I do foreign exchange because I have a customer who's doing some trade and they need foreign exchange associated with paying that trade receivable. That's how I do foreign exchange. So anywhere from 3/4 to 80% of what I do is really off the back of what customers are doing. So as long as my customers are doing things, and as long as they're growing their businesses, well then I can make money attached to it. Where in the past in markets businesses have seen a lot of lumpiness is when they actually haven't been attracted or attached to customer flows, where people are taking trading risk that isn't associated with a pure customer activity, it's just trading market risk, which we do very little of in the bank. So I would say that as long as our customer business continues to grow, our markets business should also continue to grow.
And it would seem that I think people in the long term buy the Asian century story, that Asia is obviously as a whole growing faster. When we look at some peer banks in Asia with their recent results, there's margin pressure, there's some credit quality pressure, there's some earnings pressure.
Are you referring to Standard Chartered?
Standard Chartered
right,
in particular.
Right. Mm-hmm.
Is there a read-through there for ANZ from what we're seeing?
Well, I wouldn't say that there's a read-through. I mean, when you really dig into the results of Standard Chartered, if we just focus on the Asia-Pacific challenges which they had, which I think is the thing you're trying to focus on here, really you first have to start with where did their big problems arise. And their problems really arose in two places. One was in Korea, where we have a very modest presence. They have a very substantial presence. And the second is India, where they have a very substantial presence and they had been investing, assuming larger growth coming out of that. And that didn't happen. So those were two markets where we have a very relatively modest amount. I think the more interesting dynamic, though, is when you look at the mixture of how we've built our business in Asia. And where we've built our business in Asia is one is to have a predominantly investment grade business and a relatively modest percentage of what we call non-investment grade business when we lend people money. So when we lend customers money, we're focusing mostly on the top end of town, the investment grade clients. That ratio of investment grade and non-investment grade between us and Standard Chartered is quite different. They have a much more larger component of non-investment grade customers. So what that means is that when the economies don't do so well, those non-investment grade customers have a higher risk of default. So we've been focusing on a very top end of town growth strategy as it relates to our business. And then the second issue that differentiates us from the credit risk that they had around this top end of town is the tenor with which we lend. Most of our business is around trade flows. So 75% of my balance sheet in Asia Pacific is less than 1 year. A stark contrast to what Standard Chartered has. So really the differences between us and Standard Chartered are things like they have high concentration risk in a couple of economies that haven't been doing as well as they'd expected. And the second is that the way in which they focused on their customer set broadly in Asia is quite different than ours, primarily around this non-investment grade, investment grade dynamic, and around the tenor that we apply, both shorter term versus longer term.